Good afternoon. My name is Aaron Jacobson Swanson. I'm the president of CFA Society Atlanta. I'd like to welcome you all to our online series, Dynamic and Disciplined Investing, Can We Do Both? I also encourage you to join us and register for our 3 upcoming online series. On March 23rd, we have Financial Modeling Best Practices, 10 Tips to Build a World-Class Model. On March 27th, we have our inaugural Ethics Challenge, which is from 10 a.m. to 2 p.m. Now, on April 14th, we have the Future of Sustainability and Investment Management, Research and Tools. I'd like to extend a special thanks to today's webinar sponsor, KKM Financial, and to today's speaker, Jeff Kilburg, the founder and CEO of KKM Financial. Jeff is a regular CNBC contributor and has over 20 years of investment experience. Without further delay, I'll pass it over to Thomas Irwin, Senior Director of Business Development at KKM Financial, to get us started.
Thank you very much, Aaron. And thank you very much, Kathy. Thank you for all the participants today. We're really excited for the opportunity to speak with you. It was just 1 year ago that Jeff and I were in our last in-person meeting in Boston. And I was actually heading back to New York. Jeff was going back to Chicago that night. And we found out later on that night that everything was basically going into lockdown. And here we are about a year later. I think in learning what we've seen over the last year, the topic for today is very apropos. There's times when being dynamic and disciplined both are the right thing to do in terms of your portfolio. Trying to figure out how to do and when to do each one is always a challenge, and that's what Jeff's here to talk about today. I think, as you'll see, he's a very dynamic speaker, but most importantly, with his background, I like to call it from the gridiron to CNBC. Jeff had a playing career at Notre Dame back in the 90s under Lou Holtz, and worked in the bond pits of Chicago, and to where he is now as the founder and CEO. So Jeff has a pretty innate ability to talk about anything that's really going on in the world as it relates to the markets, and I think does a terrific job in doing so, and I think you'll all appreciate that. Obviously, we did this today on a pretty broad basis, but we're happy to do, if anyone has any questions, happy to take conversations, presentations offline and do them on a customized basis for you. So with that, I hope you enjoy the day. Thank you very much for the opportunity to speak with you. And here's Jeff.
Well, thanks, Tom, and I appreciate Aaron and Kathy as well for letting us present today. And I'm excited about this conversation. We have a lot of conversations on CNBC, but nonetheless, this is a conversation we really wanted to curtail and tailor towards the CFA Institute of Atlanta. So if there are any questions, I want this to be somewhat informal. So if I'm in the middle of my presentation and you can pop in a question, I'm happy to try to adjust it as we're going along here. But I'm really excited today about the opportunity to talk about how we can be disciplined and dynamic. And if we talk about that, as I show off my Zoom skills here, the disclosure that everyone just read, we talk about disciplined investing. And I think it's so critical in this moment in time. And we can talk about how more importantly discipline has become as we move out through the presentation. But we can talk about dynamic, and that's really what worked in 2020. We talk about what worked in 2020. It was being disciplined, it was being active, it was being dynamic. But there's always a challenge in marrying the two. So I hope today, in about 35, 40 minutes, we have an opportunity to provide an investment solution for you all as you continue to think about how you're constructing portfolios. Moving on here, it's really important to understand where we've come from. And Tom did a great job of talking about it was a year ago, and it was hard to believe that it's been a year since I've been on a plane. CNBC actually sent out a studio here. So, having my own studio here has been fantastic. My commute is about 12 stairs away, but nonetheless, we're looking forward. We're optimistic of some normalcy. But what's transpired in that year, no one can ever really truly prepare for a pandemic. But I want to talk a little bit briefly about how the outlook has changed. And I think you can see how the landscape has really changed so dramatically in just 1 year. we talk about the massive injection of volatility. We saw the most acute volatility, the fastest drop in the S&P 500. If we rewind to February 19, 2020, that was the all-time high of the S&P 500. We fast forward to March 23rd, that was a 35% drop. 35% drop, the quickest in the history of the stock market. Not the largest, but the quickest. And that type of volatility injection really caught a lot of people off guard. I've traded a lot of different markets from the 90s, 2000s to the Great Recession. But when we saw volatility, specifically in the VIX, move above 80, above 85, and kiss and touch 90, this is like nothing we've ever seen before. And this is a lot of the components, but it also provided a lot of opportunity. We talk a lot on CNBC about the rotation trade. This rotation trade really is interesting. And just to kind of stop on that for a moment, we go back last 10, 12 years, it's really been not simple, but it's been pretty simplistic that as long as you were following some of the indices, the equity indices, you had the ability to capture this move up. Now, all of a sudden, since the pandemic has hit, we really see a change in mindset, a change in portfolio construct, and a change in discipline. And this rotation trade, which was started arguably in September of 2020, when we saw that first bit of selling. If you remember September 2nd, we had a pretty tough day in the Nasdaq 100, all the FANG stocks that you hear us talk on CNBC, sometimes ad nauseum about, but that's what we really saw, that beginning, that first inning of the information technology selling off and the rotation trade into some of the industrials and into some of the laggards we know. So we think that rotation trade continues to prevail. I think that theme is going to be embraced as we move forward with additional stimulus funds, additional infrastructure. But that's something I think is really important to understand, that this rotation trade really is happening. I think you have to embrace it from a discipline perspective. We also talk about the intervention. No doubt about it, on March 23rd, when Fed Chairman Powell came out and stated that he would be supporting the marketplace in an unlimited capacity and in perpetuity, that really was the bottom. I know that day when Fed Chairman Powell came out and talked, that day we saw the market down over 12%. It kind of recovered and it was only down 9% on the day. But that was the absolute low, the bottom, if you will. And we saw the markets really move back. We saw copper. Dr. Copper sometimes provide leadership. It absolutely did that moment in March. But we saw the markets move higher with that injection of confidence. We also talk about how we can also see what is important moving forward. And this is the migration. This is the conversation we're having with a lot of different investment advisors, a lot of different family offices, is how can you migrate towards more of a tactical allocation? What else is important to understand in your discipline, your methodology? I think it's really important, going back to the rotation trade, it's owning epicenter names, owning essential names. And we'll talk more about the essential names, but you hear a lot of folks talk on CNBC about these epicenter, about these essential names. And these are names that are tangible. These are names that we really can digest. And more importantly, these are names in your portfolio that your clients know. They've seen these names before. In the bigger picture, these are the names, the companies that should benefit as this rotation trade persists. And this isn't just a rotation trade for a month or for a quarter. This is a multi-year. And this is really kind of the shift back to value, which we haven't seen for quite some time. Lastly, I think this is really important. I was on CNBC yesterday talking about the 10-year note yield. We had an auction yesterday of $38 billion. We have an auction today in about a half hour, seeing the 30-year bond auction, about $24 billion. And what does that mean? Well, it means that the government, who just passed a $1.9 trillion stimulus package, they need to finance it. So they're doing these weekly auctions. You're going to see the persistence of these weekly auctions and the size of these weekly auctions continue to grow. But it's interesting with the 10-year note moving in the way it did, that velocity really made people rethink about inflation concerns. So we'll dive into that a little bit more here. But I think you have to keep two things in mind when we talk about interest rates, or when you're having those conversations with your clients. Interest rates are still 18 trillion. 18 with a T, $18 trillion in negative yielding instruments. You look at the German Bund, it actually moved lower into negative territory today, but let's just call that minus 35 basis points with the 10-year at 1.5, quite the discrepancy there. Therefore, illuminating the fact that maybe the 10-year is a little bit of a juicy yield. Hard to say that, I know, with a straight face at 1.5%, but that is the environment we're in. Lastly, when you talk about interest rates, we have to realize that the appetite to potentially move out of negative yields into a 10-year note product makes a lot of sense. And the component of $5 trillion sitting in cash, that equals, when it's all said and done, if the Federal Reserve is above $10 trillion, that $5 trillion is just sitting in money market funds right now. That's half of all the balance sheet expansion. So I think it's important to understand the outlook has changed. So if we go back here, there we go. So disciplined investing, this is something that's really critical, I think, to embrace. I think a lot of the CFAs in the chapter and CFAs globally really embrace a disciplined investment thesis. And that really allows you not only to potentially produce more alpha, but also allows you to create a consistent investment process, a repeatable investment process. And pre-pandemic, I used to travel to a lot of different conferences and speak, talking about this consistent, repeatable investment process. That certainly helps you scale your practice, helps you simplify your practice. But the discipline component, I think, is so critical because we have so much noise coming at us and we worry about the acute volatility, but nonetheless, the disciplined investment approach, I think, really makes sense. Now, I know Tom talked a little bit about my Notre Dame days, and there's probably some folks out there who don't love Notre Dame, but just a quick little moniker here that Coach Holtz taught me back in the 90s, and it's what's important now. You saw the slide of going down the tunnel, but what's important now, when, really makes a lot of sense. So when we talk about what's important now for you, for your clients, for your portfolio construction, we really believe having discipline and being dynamic, that is important now. And that's going to be a reoccurring theme, not just in 2021, not just to close out Q1 of 2021. We think this carries through for the next couple of years, as this is really important moving forward for investment theses. When we talk about Fed Chairman Powell, which I kind of alluded to, he certainly is keeping an eye on the markets. We see this in every press conference. Right now, the Federal Reserve is in a dark period. March 17th, St. Patrick's Day. I'm hoping that we're going to be able to celebrate here a little bit in Chicago. St. Patrick's Day on March 17th, that's their next meeting. We will get continued rhetoric. Now, what's interesting about the marketplace was that he decided on his last Q&A, a week before last, when they went into the dark period, he decided to reserve and not really comment anything. People, or the market, I should say, was looking for some type of operation twist, maybe some type of rhetoric to maybe control the shape of the curve or have some concern. He refrained, and that type of conversation or lack of conversation made the 10-year yield move higher, went above 1.60. So if we rewind just from February to where we are now, we've seen just a dramatic move higher in rates. I've been on CNBC a couple different times talking about their treasury yields. I think they come back down. I was on yesterday talking about the fact that we do have a little bit of a appeal now as people are looking to potentially rotate out of negative yields and come in here. But I think this is going to be a consideration in bigger picture. We're not too far from where we were a year ago. So I know there's been a lot of volatility, acute volatility in the 10-year treasury yield, but I think this is part of the process of rates moving higher. But my forecast for Q2 all the way to Q3 is that the 10-year yield will come back down to 1.25%. That should quell markets, specific to the equity markets. When we talk a little bit about the rotation trade, this is where it gets really important to really incorporate your focus. So we all know the FANG stocks. And when we talk about these FANG stocks, which we do a lot on CNBC, I think it's important to understand Facebook, Apple, Amazon. We kind of switched Microsoft out for Netflix, but we still have Google. So if we look at those names, let's look at the S&P 500, which is the top 10 names are FANG stocks. Those top 10 names represent about 28% of the S&P 500. The FANG stocks in the Nasdaq 100, again, a big market cap weighted index like the S&P 500, that's going to have an effect on your investing thesis. So understand this rotation trade is that people aren't walking away from technology. We're going to talk a little bit later in the presentation about some of the sectors that technically are still revealing strength. We run a lot of different ETF model portfolios, which are powered by Nasdaq Dorsey Wright. So we utilize the relative strength methodology, and you'll see that tech is still revealing strength. But I think it's how you own it, your discipline. What type of exposure? Did that exposure grow too quickly, too fast? Are you vulnerable? Are you susceptible to a bigger pullback? We just saw a 10% pullback until essentially David Tepper came out last week and talked about now's a good time to buy the Nasdaq 100. So I think it's the discipline you have to have in understanding of what your actual exposure is in your instruments, in your vehicles. However you're building your models, however you're picking your stocks, I think that's the discipline. And having that type of plan articulated, if it's in a spreadsheet, if it's on a moleskin notebook, whatever that conversation is, it has to be articulated and written down to help you with your discipline to stay inside of your parameters. moving on to the other conversation I think is really critical. This is one thing that everyone knows about. This is not a news flash here, but it's really important to understand the effect of the stimulus dollars. They're talking about the $1.9 trillion worth of stimulus that just got approved. That's going to put a 1% growth on global GDP. I know a lot of the people who are potentially receiving checks, the survey that went out, some of the survey recipients wrote back that half of that $1,400 check they're going to put into the stock market. Maybe it goes through Robinhood. Who knows? But the point is that there's a lot of money awash in the system. And this US government stimulus is unequivocally the most we've ever seen. If you go back to the Great Recession, if you go back to the world wars, we've never seen this type of liquidity injected into the marketplace. And no matter how you feel about that, I don't get political, I just like to talk investments, but no matter how you feel about that, that is the situation we are in. So when the Fed is all said and done, getting above $10 trillion on their balance sheet, I think that's really plausible. So it's really mindful to understand inside of your discipline where you have different targets and exposures and target allocations articulated. What does that mean with the stimulus? Because this is a little bit different kind of animal when you compare it to the Great Crisis, Great Recession back in 2008. So one of the things that we really want to talk about to help us with our discipline is to understand, and I'm not even going to cover the GameStop conversation, the AMC conversation. We're going to talk about essential names. And this essentiality theme, that is what we really focus on. I'm the portfolio manager of the Essential 40 stock fund, and we get excited about this portfolio because it focuses on companies that are deemed critical to the US economy and the American way of life. This is an equal weighted basket, but it really helps understand when clients see this. We offer this in the SMA. We also offer it in a mutual fund, ESSIX is the ticker symbol. But these companies, these are 40 names that are truly recognizable, tangible for your clients, and they should be able to participate. We've seen this just in the Essential 40 model portfolio in the last 6 months compared to the S&P 500, which remember is market cap weighted. That outperformance of the Essential 40 has been nearly 700 basis points. So that's a big deal. But this type of discipline, if it's essential names, maybe you have a different portfolio that's a little bit more honed down, where you have more of a concentration into a sector you like. But the essentiality theme, I think, really is important to incorporate in your discipline. And this also helps you with your dialogue with your clients to talk about some of the names, to talk about how Intel really suffered last year and how Intel is coming back. There's a lot of different names that really fit our essentiality theme, but I think that's going to be a benefit when you're having these conversations to really understand the exposure. Think of the essentiality theme, which we incorporate at KKM, as a step further than Peter Lynch. Peter Lynch, we all know him and love him. In the 1980s, he incorporated buy what you know. We believe that the Essential 40 takes just a step further, buy what you use, buy what we believe to be critical to the US economy and the American way of life. If you look at some of the constituents here, it's interesting to see one of the top components year to date is ExxonMobil. And of course, ExxonMobil was one of the worst constituents last year, but we've seen a flip in energy, so that's been great to see. But the essentiality theme, it's a large cap core strategy. It's for investors to take a longer term view, and we really believe that these 40 names are essential and critical to the US economy. So this is the Peter Lynch 2.0, if you will, and we get excited because this essentiality theme can bring in discipline in your portfolio. And what's nice about the portfolio is that we will rebalance it, and there's tax sensitivity on that rebalance, but this is all coming back into the fact that when you look at the FANG stocks and you see that type of susceptibility or vulnerability inside the S&P 500 with that concentration, when you talk about 2 or 3 names representing 15, 20% of the index, having that equal weighted theme, having that equal weighted discipline does make a difference when you see volatility and repositioning, not just in retail investors, but institutional investors, but this is a global repositioning we're seeing right now. So when we talk about how to be dynamic, I think it's really important to understand dispersion. And Kathy actually has a white paper that we created on dispersion. But dispersion is really important because dispersion is the fact of the matter that we're always trying to analyze, is there a difference between 2 sectors? Is there a difference between asset classes? Where is that dispersion? And that dispersion, if approached properly, allows us to capture that alpha. So dispersion goes back many, many years. We're always trying to figure out, I know the S&P added another sector on us, but let's just talk about the S&P 500. Those sectors, certainly there's disparity, there's dispersion. Last year, we saw energy by itself, affecting crude oil, but energy by itself and banks were the two worst sectors. Energy was just forgotten about. We've seen it completely rebound, and all of a sudden the banks are back in favor. But nonetheless, it's interesting to see this dispersion. And if you have a dynamic and a tactical strategy able to capture that dispersion, that's where it gets exciting. And that's where you can potentially seek to produce alpha. So we get excited about capturing dispersion, but more importantly, if you're looking to understand dispersion a little bit better, I know Kathy has that dispersion white paper from KKM available. If we talk about how this dynamic component really makes a difference, I want to talk about the top decisions that really drive dynamic investing. And I think at this moment in time, when we saw the year unexpectedly last year, how we saw performance come back after just the pullback we saw, the historic pullback we saw in equities back in March, it's important to understand that there's a need to rebalance existing portfolios. I think everyone understands that clearly, but there's also a consideration. I talked earlier about reducing exposure to certain sectors. Information tech, big sector that we love and embrace, but for the last quarter or so, we've reduced exposure because we're a little bit concerned of how quickly it's moved. Now we can talk about all the different sectors in there, but it's important to understand the real risk exposure in that portfolio and where you're potentially a little bit over tilted because you're outside of your target allocation weightings. We talk about refocusing priorities, and certainly this is all inside of our risk suitability, knowing your clients, knowing the client portfolios, or potentially some of the risk buckets that you have already created. I think it's really important to understand that and how you can explore a tactical exposure that makes all the sense. And we're big believers of utilizing technicals to help mute some of the noise. But even if you're not a big believer in technicals, a lot of advisors are incorporating to some extent of their portfolio construction. They want a little bit of a technical approach to that portfolio construct to help either be additive to their fundamental approach or be additive to their stock picking approach. And that's where we're kind of marrying the two of a discipline and a dynamic strategy. And that's where we get excited about tactical. I think it's important to talk about assessing potential inefficiencies. We always want to have the conversation when we're working with financial advisors to make sure that they are having this dialogue with their clients, revisiting long-term investment goals. I know living here in Chicago, we talk about moving back to downtown city. Well, I think that has changed a little bit. Maybe our retirement plan now is maybe moving to Florida. So I think all those conversations have changed in a dynamic and a drastic manner. So having those conversations, I think, are really important to help better understand how you can service that client. We talk about the upcoming scenarios of what state economies reopening really looks like. And I think that is really the measuring stick that a lot of investors, a lot of portfolio managers and asset managers globally are trying to really understand and digest. And that's where we get challenged, even living in Chicago, of what the real economy is compared to Wall Street. We're seeing, near all-time highs in, the Dow Jones, S&P 500, and at some points we're seeing businesses. We're seeing a lot of people we know and love here in Chicago having a hard time moving past because of the economy shutdown. So I think understanding and engaging the reopening of the economy, I think it's a really exciting conversation. But we get more and more optimistic. I know just a couple of days ago we saw Alaska now opening up all vaccines for anyone above the age of 16 who wants one. We're optimistic here in the state of Illinois that we're going to move into phase 3, which in essence would be the same rhetoric, would allow anyone above the age of 16 to potentially get a vaccination. So I think the acceleration, we heard the Biden administration just bought another $100 million J&J vaccine. So I think this is all coming here. And I think the surprise is that we're going to see the economy reopen in a more feverish manner than initially anticipated. When we talk about how to uncover opportunities, I think this is where it gets super exciting. And if I move, I think I can move this. Hopefully I'm not blocking this, Kathy. But if we talk about what 3 opportunities that we're focused on at KKM, we talk about the essentiality theme. These are companies that you use. These are companies you want to own. And we talk about what happened in the pandemic, and certainly we saw small caps get thrown out. We saw small caps resurge. But some of these essential names that we have in our portfolio, we think these names are really going to have pricing power moving forward. They survived the pandemic. They're powering through. They're becoming more efficient. But the pricing power to potentially raise prices and deliver to the shareholders, that's what's getting excited about some of the names that we deem essential. Tactical approach. We talked about being tactical. That really relies on technicals. Our portfolios are analyzed and screened in a quantitative way. every week. Do they trade every week? Absolutely not. But having the ability to lean upon technicals when you see bouts of acute volatility, this is like no other time when we see markets move to the extent that the volatility and the actual realized volatility, which means the actual market moves from day to day, going back to March of 2020, it was overwhelming. Even for an experienced professional trader like myself, it definitely took my breath away on a couple of days when you saw the exaggeration of those moves, 9, 10, 11, 12% moves in the S&P 500. The S&P 500 index was trading like a penny stock. Lastly, sector tilting. We're big believers. This is how you can capture on dispersion. If you can have a sector tilt, it's really critical if you have the ability to have exposure to potentially capture alpha on sectors that are revealing strength. But more importantly, and this is really critical of a sector tilting portfolio or methodology, I think it's even more important to stay away from sectors revealing weakness. So last year, our model did not own financials, did not own energy. We owned energy late in Q3 of 2020, but by avoiding those two, we were able to kind of step away from a lot of the carnage in those sectors. So that's really important, I think, understanding if you're looking to implement some type of sector tilt or sector rotation, which of course can be encompassed as a large cap core strategy. I want to touch on this. This is our tactical rotation model, and this is the current makeup of it. So this model, which is screened weekly, it does trade often, all contingent upon volatility. So if we look at the year 2019, we had 3 or 4, I think maybe 5 trades in the portfolio, where 2020, the massive volatility injection, we saw 11 trades. Currently, it's positioned right now in the small caps, consumer services, industrials. This was the conversation we had about the month of September when we saw the diminished exposure to information tech and people coming into industrials. Think of names like Boeing, think of Lockheed Martin, think of GE. I know it's not having the best day today, but names like that have kind of resurfaced. Transportation, oil and equipment services, regional banks just came in. The shape of the curve certainly helping regional banks, probably favoring regional banks. This is my discretionary component, but it's favoring regional banks versus the larger wirehouses, but the technicals are also revealing strength. Home construction, it's been off the charts here in Chicago. We continue to see home construction and houses, go for people are lifting offers in the suburbs. I think that's kind of what's happening in a lot of major cities across. And last but not least, you're seeing semiconductors. You're seeing semiconductors on the 6-month perspective really attract assets and outperform. And names like NVIDIA and Qualcomm, you're going to continue to see names like that prevail as we move forward. When we talk about the rotation, I think that is the dynamic piece of the puzzle. Being able to show and reveal to your clients that you have the ability to be active, be dynamic, and they are able to see those actual trades in an SMA format or a UMA format. That's, I think, a big differentiator. And you can go back to this tactical rotation model in the month of March. The model revealed the fact that it was going to risk off mode. It took a 30% position in AGG, which, as you know, is the iShares aggregate bond ETF. And that, by owning that on March 4th, we were able to mitigate a lot of risk and a lot of the carnage that we saw in the S&P 500. What's interesting about the tactical rotation model, though, is that it has the ability to be nimble. And that weekly screen allowed it to be nimble. So on April 1st, we went back into a risk on mode, removing that 30% position into fixed income or AGG, aggregate bond exposure. And we saw the ability to capture the upside. So this tactical rotation ETF model portfolio was able to outperform the S&P 500, not only in the month of March, not only did it look active and dynamic in the month of March by mitigating about 10 to 12% on the downside, throughout the year on that parabolic move to the upside, it was able to capture and outperform the SPX by about 650 basis points. So that's 6.5% of outperformance with a different risk profile. That makes a lot of sense and really resonates with clients when you're talking about what are you doing to help mitigate risk in this type of environment. There's so much uncertainty surrounding the pandemic. This tactical model, we've seen a lot of inflows to help that piece of the puzzle when people are constructing portfolios. When we talk about the top 5 sectors, I just kind of wanted to give you a little bit of a look underneath the hood in what we see as our top 5 sectors. So these are the top 5 sectors right now, and this is our sector rotation model. And our sector rotation model is really focused, and you're seeing a lot of technical attributes towards semiconductors. We're also seeing U.S. technology still abroad in a safe number 2. We're seeing software. These are a lot of names like Salesforce, CRM, We're also seeing expanded tech, and lastly, consumer services. So what's really, I think, fascinating, you hear all the conversations about tech, and it's time to sell tech. We're not saying it's time to sell tech. We're saying in a disciplined manner, you should own tech. In a disciplined target allocation, you should have tech. But clearly on our sector rotation, we're not abandoning, we're not walking away from technology. We're just going to own it in a proper way. And that equal weighted is the way we're exposed in our sector rotation, which is powered by Nasdaq Dorsey Wright. But this is important, I think, to understand, as we have so much news, and the news media right now is really kind of frowning upon technology. We believe that technology and some of the bigger names, of course, the FANG stocks, you're going to continue to see strength in Microsoft and Apple, and certainly Google in a post-pandemic world. And that's part of the important piece of the puzzle, to understanding how these different stocks are going to continue to grow when we look at names like Amazon, which of course we incorporate more and more, it seems like, every day in our life here at the Kilburg household. So I kind of want to open things up a little bit here. Some Q&A. I'm excited to either do a deep dive on a specific question or talk more global macro like we do sometimes on CNBC. But I think the key takeaways, and I'm going to let Tom jump in here, but the key takeaways: remain objective about the new economy, the opportunities, being disciplined, being dynamic. I think it's also really critical to remain invested as the global central bankers. We saw the ECB, we saw what they said today. So remember that there's a commitment from the ECB, the PBOC, the Bank of Japan. Global central bankers everywhere continue to assist the market recovery, this global recovery, which certainly can be uncertain at times, but we are certain about the fact that global central bankers are committed specifically on their balance sheet. So lastly, I would say remain disciplined and dynamic. Your investment plan is your investment plan. It's bespoke, it's curtailed, it's tailored towards your clients, but having that discipline, having that process implemented will allow you to create an investable, repeatable investment process. So I appreciate everyone's time. We left a good chunk of time here to take in some questions. So Tom, I'm going to come up for air, my friend, and let you chime in and see if we have any questions here.
Great. Thank you very much, Jeff. And thank you, everyone, for joining us. Speaking of disciplined and dynamic, now's the Q&A portion of the conversation. So we get to test the disciplined and the dynamic attributes of one Jeff Kilburg. A lot of times we can go into anything from the presentation. With Jeff's background, we can talk about CNBC, we can talk about Notre Dame football, we can talk about the Bond Pits of Chicago. The first question may be, considering we're speaking to the CFA Society of Atlanta, Jeff, as a senior in high school, you made a trip to the University of Georgia and did not go to Georgia and instead went to Notre Dame. Could you please comment on this?
I was a big fan of University of Georgia. Go Dogs. I'm still a fan of the Bulldogs, but my allegiance to Notre Dame and Coach Holtz really working over my parents was the decision that kept me up north here. But I do see a question popping in here, Tom, about the very large rotation that we've seen to value and away from growth. Where are you on both your thoughts and expectations in the portfolio? So this is a great question. And I think this really resonates. And if you see the Essential 40 strategy, we did see this equal weight strategy was certainly encompassed technology, but had maybe a little bit more of an industrial, it certainly had more of an industrial representation than information tech when you compare apples to apples in the year of 2019. Now, all of a sudden in 2020, when you see this rotation walking into value, which is the conversation we have a lot on CNBC, I think this is really early innings. So I think the fact of the matter that we will see more and more value names, and we talk about names like GM, International Paper, 3M. A lot of these names don't have the sizzle or the typical sex appeal to talk about. I know they're not Peloton, I know they're not Zoom, which we're on right now, but these are names that I think really have deep value. I think we're going to continue to see growth. I know Oracle is having a rough day off their earnings, but these are names that are continuing to prevail. And those value names, Intel is a perfect opportunity where they kind of got forgotten about in the move higher. I know AMD had a great year last year, but Intel is still the world's largest chip maker. So Intel, which is a constituent in our Essential 40 model, certainly is trying to capture the value. So we're big believers. This is a large cap blend strategy. We're not going to walk away from Facebook, Amazon, Apple, and Google. We do not have Netflix, we have Microsoft, but where we really focus on the industrial side. So we have nearly twice the representation in industrials of a Lockheed Martin, of a Boeing, of a Delta Airlines. A lot of these names that you'll see in this portfolio get exciting for those who get excited about the shift from growth to value.
Jeff, we have another question, came in over email. How should I balance protecting assets from a potential combination of inflation and rising tax rates?
Well, that's a great question. And I think inflation, which the Fed magically loves to talk about, and it gets us all talking about inflation. I don't think the inflation scenario is where we believe it's going to be, or where the marketplace is. The market got out in front of it. My friend John Najarian, who talks on CNBC just about daily, was talking about, I think people are trying to get out in front of the fact that the Fed wasn't going to talk about inflation. And that's why you saw the 10-year note move 40, 50 basis points. So I think it's important to understand that we are going to have the ability, with all of the moving parts in the stimulus package, I think you're going to be able to see rates normalize, move higher, and still see equities participate. Are we going to see fixed income have the year like it did in 2020? No, I think that was a historic year. So we think that there's more of an opportunity to be more tactical, and that tactical portfolio that we have is actually replacing a lot of fixed income exposure for some of our financial advisor clients. But I think interest rates are going to remain subdued. I think the lower for longer conversation in the bigger picture is still going to be present. I don't see a 2% 10-year yield. I know there's some really smart people out there talking about 1.75, 2%. I traded the 10-year note, 30-year bond futures for a long time. My perspective, which probably lists a little bit more towards David Tepper's, I'm not in the Scott Minor camp where we're going to have negative yields, but I think yields come back down. And I think it's twofold. The inflation fears that are being dramatically overblown right now, I don't think exist. I think inflation is on the horizon. And remember, the federal government, how do they measure inflation? They strip out energy and food. And that's right, because we don't drive anywhere, we don't eat any food. But I think it's important to understand the inflation fears will calm. I think when those rates come down, that's going to provide an environment for cats and dogs to live together. So I think the component of the 10-year note being stabilized or tethered to 1.25 is going to be a great environment for stocks to continue to move higher. And I know valuations have to catch up on certain sectors or certain specific stocks, but equities remain to be favorable in a risk-on environment with the Federal Reserve and their accommodative policy.
Thanks, Jeff. We have another question just in from David. Thank you, David. Have you done and work on the seasonal swings in the market, i.e. sell in May and go away?
That's a great question, David. And we have done some research on this. Unfortunately, my perspective, KKM's view, is that a lot of the data that we had pre-COVID, pre-pandemic, is just not able to be utilized in this environment. I think there's so many other inputs into our formula. The typical sell in May, go away, I think is a historic measurement, and historically has been somewhat accurate, contingent upon what cycle you want to look at. But right now, I would not want to sell in May, because I think you'd be lamenting as you walk away, because I think once you see a lot of this cash that has to be put to work, it's $5 trillion has been identified right now. I'm not even talking about the $18 trillion in negative yields, but we did see this is interesting. Yesterday in that 10-year note auction is interesting to me, because I'm kind of a bond dork, but it's interesting to me that we saw the direct bidding increase. And even though it wasn't the best bid to cover ever, it was a somewhat impressive auction because of that direct bidding. And what does that mean in layman's terms? Well, it means that potentially the Bank of Japan, it means some of these big institutions, these global central bankers, were directly bidding. And that increase makes me believe that they're transitioning some of their book out of negative yields and into the 10-year notes. So that's why I'm a believer that we're going to see rates continue to stay subdued, which, long way of answering it, David, is going to allow equities to go higher. So my advice would not be to sell in May of 2021.
Thank you, Jeff. We will give a moment or two for any additional questions. Just want to let you know that I and Brendan Ambrose, we're down in Charleston, South Carolina, and Jeff is pretty desperate to hop back on a flight. He just got his vaccination earlier this week. Interestingly enough, I believe today is the first day that more Americans have been vaccinated than have had the coronavirus. So pretty profound prophetic marker. And if there's anything that we talked about today that you'd like to talk about offline, please let us know. Like Kathy has said, the materials from today's presentation will be available, and some additional talking points and white papers. If you'd like to talk to us, we're happy to do so, either virtually or in person. So with that, I'd like to thank you all and turn it over to Kathy. And,
well,
and
hold
again,
on, before we go to Kathy, Tom, I just want to kind of tell one quick story about my official visit down to the University of Georgia, which I was a big fan of, and it was my second choice. My parents would have let me go down a little bit further away from home. But I was very fortunate. I was able to walk out Uga, the bulldog. I was able to walk him out. It was November 28th, 1992. I think I'm accurate on November 28th. 1992, you guys were playing Georgia Tech, and it was great because I was being recruited by Georgia Tech pretty heavily as well. And the Georgia Tech coach tried to come over and wave to me when I was walking out of the tunnel, and the Georgia coach almost jumped him. There's almost a fight right there. But big fans of University of Georgia. I'd love to come down and see a game, hopefully, when we're back to some normalcy. But I didn't mean to interrupt you. But yeah, very appreciative of everyone, and looking forward to hopefully having the opportunity to see you all in person.
Thank you, Jeff. That was a great and thought-provoking presentation, and thanks to the KKM Financial team. We appreciate everyone who connected with us today, and look for an event survey to follow, including the webinar replay, presentation, and the supplemental information that Jeff and Thomas mentioned. Thanks, everybody. Thank you again, gentlemen.
Thank you.
Have a good afternoon. Bye-bye.
You too.